Prices are increasing across rich countries at their fastest rate in 25 years. The latest figures from the OECD are adding to concerns about the rising cost of living, while the head of America's central bank has warned that inflation is a severe threat to the US jobs market. Our business editor Stephen Carroll is here with more. What are the latest figures tell us, Stephen?
They're giving us an idea of the picture across a range of rich countries. We've heard individual countries reporting very high inflation figures, but what we're seeing here is the overall trend from those 38 members of the OECD, who are largely some of the richest countries in the world. And they show us that the pace of price rises rose to 5.8% in November. And that is, as you said, the highest since May of 1996. Outside of the OECD, the picture does vary a little bit more. New figures, for example, from China out today actually came in less than had been expected. Inflation there, consumer price index, rose by 1.5% between November and December. Within the OECD, though, the highest price spike is being seen in the United States. We get new numbers from the US later today on inflation, although the last ones from November were the highest in nearly 40 years. Economists are expecting the December figures to be potentially even higher. The head of the Federal Reserve, Jerome Powell, saying that inflation is now a risk when it comes to the recovery in the US jobs market.
To get the kind of very strong labor market we want with high participation, it's going to take a long expansion. We can see that participation is moving only very slowly. And to get a long expansion, we're going to need price stability. Right. And so in a way, high inflation is a severe threat to the achievement of maximum employment and to achieving a long expansion that can give us that.
So what exactly is driving these price rises? In
most places, the most important factor is the cost of energy. If we look at the figures from the Eurozone for November, we can see the price of energy rose by 26% between December 2020 and December 2021. The next fastest pace, the next category that shows the fastest pace of price rises is food, alcohol and tobacco, and it's only just over 3%. So really, we can see that energy is what's clearly driving the price rises here. The issue with energy is coming particularly from an issue around supply of natural gas. We have a supply and demand problem here because as economies reopened after the first round of coronavirus lockdowns, we didn't see supply pick up to match the increased activity in the economy. Then we had a colder winter last year and a warmer summer, which kept demand high as well, which meant the usual time we have to build up stockpiles of natural gas didn't happen. The result of that is a supply crunch. Prices went sky high. Things have improved slightly towards the end of last year. We had some new supply arriving on the market, which helped to ease some of that crunch around supply and demand. Gas prices have come down slightly from the peaks that we'd seen in December, although they're still much, much higher than they were this time last year. Natural gas is also used to generate electricity in Europe, so that's another bill that we've seen get much bigger.
And do we know how long this spike in inflation is likely to last?
That's the big question that central banks are trying to grapple with at the moment. Is this temporary or could it last a little bit longer? Central banks' primary mission is to have price stability. So they like a little bit of inflation because it's a sign of a strong economy, but not too much. And this is generally considered too much. At the same time, central banks don't want to upset the economic recovery from the pandemic by withdrawing the stimulus they'd given over the past 2 years too quickly. So we're seeing a different approach being taken in different places. If we look at the United States, the Federal Reserve taking a slightly more aggressive approach. That's because they're worried about inflation lasting longer there. They've signalled 3 interest rate rises are on the way. Federal Reserve Chairman Jerome Powell saying he's expecting inflation to peak around the middle of this year. On the European side, the chief economist of the European Central Bank has said that he expects inflation to slow down this year and to be below the 2% target for the bank by next year. Philip Lane telling the Irish broadcaster RTE earlier this week the case for rising interest rates is not there, as he doesn't believe that high inflation will last.
Stephen Carroll with a deep dive there into the latest trends in inflation. Thank you very much.